Good afternoon, everybody. Welcome back to the Opportunistic Trader. It is Friday, October 26th at 11, and we have some very volatile markets, which we'll get into. We're joined by Ben Ryan of Commodity Research Group. He joined us a few weeks ago, coincidentally, on a pretty volatile session as well. And he joined us last time talking about the gold market and option opportunities in the metals market. Today he's going to be talking about gold because that's his specialty, but then he's also going to be talking about option opportunities in other markets as well. Ben, how's it going?
Doing very well, Michael. Thanks for having me on again.
Yeah, absolutely. A lot of great information you have out there, and a lot of interesting things going on, especially in all markets. And you just pointed out, we were talking a second ago, gold is at the highest level in a few months now, and we're actually trading higher in the U.S. session, and we're almost on the high of the day. We're up 12 bucks here at 12.44. The high is 12.46. So what are
Mhm.
you thinking these days?
Well, I think, where gold's been priced in terms of the volatility, put it this way, if gold right now is up just about 1% on the day, if that continues, that kind of movement, then options are cheap right now where they're priced compared to, for that kind of movement. Now we're having a volatile day. As you mentioned, the S&P right now, as I speak, is down, I see about 54 handles. So it's really not surprising. And I think it does make sense that you're seeing a little bit more volatility in gold as stocks continue to show some vulnerability, even though they've shown some good days, but then the sellers come back. So I think it's an interesting time for gold. Last we talked, we were worried that there wouldn't be much to talk about because gold was trading 1205, and it's a boring
Right.
commodity when it's trading 1200. But once you start to get away and people start to take notice, then more people start trading it, and maybe some more volatility can ensue.
Yeah, absolutely. Like you said, we were between 1190 and 1210 for probably felt like forever, but it was probably like 3 months or 2 or 3 months, and then we finally popped out of that range. It was interesting this morning with Vince Lancy. We were talking about how this week 3 or 4 times we popped up to this 1240 level and then sold off in the U.S. session. The difference, today we're actually seeing. Gold extend a bit higher in the U.S. sessions. That's a kind of an interesting divergence from what we've seen recently. And, I think a lot of people are going to be taking a look at their positions, whether it be traders or portfolio managers with longer term holdings, and, reassessing things with this equity volatility. And so that brings gold more into the forefront.
Yeah, I think I really like the way you characterized it because, what does it mean? We can't necessarily conclude anything about why it's getting sold in the Asia session. Maybe someone else has an opinion on that. But generally, if we notice a shift in trend, regardless of what it's been, we should take note, like you are, which is now the trend is buying in the U.S. And then we can ask ourselves, well, is there a good reason for that? And I think you pointed out very well. Well, sure, there's selling off in the equities. Looks like there's a little bit, of a more reason for gold to move during the equity open session in the U.S., especially if it's correlated to the stocks. And I think that's an important point that I'd like to just spend another second on is that when you notice changes like the one you just described in terms of which market a commodity gets bought or sold in, and you see a shift during one, it might be an indication that you're seeing the beginning of somewhat of a correlation, right? And in this case, an inverse correlation between the S&P and gold. And last time we talked, I kind of was mentioning that over the long term, the down equities is not necessarily good for gold. That's a common misperception, but that there are times in the market, like when Kim Jong Un was big in the news and different major news events are in the market, there tends to be more of an inverse correlation between gold and the S&P. And once it starts to present itself, it starts to manifest more and more because people say, okay, gold's the place I can go if equities sell off. So at this point, with some of the damage that's been done to the S&P, 300 or so handles off its high, and gold kind of in the middle of a longer term range, I certainly wouldn't be looking to get short gold actively here. I just don't see the catalyst behind doing that.
Right. And so, but that said, would you be looking to get long here?
I'm very comfortable being long here. I think you've seen this 1240 spot fail a number of times, and now maybe we can bring this chart out. I like to start with the shorter term chart. So here, if I take a bigger look at gold, we're looking, where are we here? So here, this is about October 5th. So this is when we last spoke. Gold was trading, if you see, this is around the 1205, 1208, 1210 area.
Yep.
So from here, we've rallied about $40. Interestingly, at the time we spoke, the value of the December straddle was about $35. So right now, the December straddle, which I can find out, but I don't believe expires for about another month at the end of November, you've broken even on that straddle since we last talked. And that's one of the things about gold and the options in gold that can be so, interesting is like, okay, this move happened. We got $35 since we talked on October 5th. $35 on 24 or 20 something days doesn't seem like that much, but you did really well in the straddle because gold is priced so low in terms of volatility, and it happens particularly when it gets to that 1200 area. So I just wanted to point out that straddle from then has broken even and has plenty of life left to it. In fact, right now it's worth about $50, so you're up $15 on it as we speak. So now I'd like to go back a little further into take a look at like 3 years. Where are we here? So you see this low here of 11 quarter, but basically, and this was back in 2016 when gold broke out and had that big day. Basically, since the early February 2016 time, gold has really not spent any time below 1200. And what it looks like, if you look on this part of the chart, is that that's reinforced. A big buyer order comes in here off of this 1200 level, just like we saw back here in 2016 and again late in 2016. So from my perspective, it's just not a spot where it's worth getting short, because on the longer term chart, there's a lot of room. And even if it's just a simple retracement, I don't think it's unlikely at all, should the stocks continue to sell off, that gold would come back and test this 1305 level that is the initial point of resistance on the medium to long-term chart. So yeah, I would still encourage being long. I would feel much more comfortable than being short. Let's put it that way.
Sure. So looking at options, can you bring up a chart, a matrix or something, and just see different ways that you might be looking to play that?
Sure. So are you able to see that there? So interestingly, I thought I'd point out a couple of things, and just to go back, quickly review where we were. At the time when we were trading 1205, I said we could sell this 1165 put because that was the low that gold had put in on the year. And I said we could buy this 1255 call flat. That's when we were trading 1205. So right now, it's a directional trade more than an option trade. But you can see the 1255 call that we would have bought is $13.40, bid at $13.70. So assume the middle, $13.60, that you can sell that out, and the 1165 put you can buy back for 90 cents. So you're up about $13 on the trade. Had you bought a future, you'd be up, as we said, about $35, $38. But again, this was a flat premium trade. So had you done 10 of those, let's say, that would have been the equivalent of owning about 3 futures and would have been a really big trade. So just wanted to point that out. Now, in terms of where things are now, this is December, but I think that what we have to recognize is that we're coming into elections, midterm elections, and that whatever comes of midterm elections can have a big impact on the way markets perceive things and ultimately the way price moves across markets. So right now, I would say we really have to be looking short term in our options, because it's going to be short term catalysts that determine where the market goes. And once the election's done, we can revisit things. But a lot might take place, should the midterms, bring any surprises. And of course, we know from 2016 with Brexit and the Trump election that the market can handicap these things wrong. And those are the times when sometimes there can be some real opportunity. So let's just take this idea. I guess we'll just take a look here about, could gold retrace to 1305, which is right here. If I take a look at the chart back here again, where my mouse is, you can see that would sort of be gold just working its way back to where the sell-off began and sort of doing a retracement from the sell-off that took place in early June, which wouldn't be unlikely in the event of a stock sell-off. So if this is where we think our target is, this 1305 area, we can then just take a look at our pricing on the options and say, okay, for about $8.40, I can buy this 1275 call. So that's 830 bid at 8.5. If I pay $8.40 and at expiration we're trading 1305, then I make $30 between 1275 and 1305, and $30 there, and I paid $8.40. So the simple math you would do is you say, okay, where's my break even point if I pay $8.40? How many times does it have to get to 1305 for this trade to work out for me? So you say, okay, $30, and you say this is approximately $8. So it goes in maybe 3.5 times. So if you did the math on that and just say 3.5 into 100, you're looking at about 25-30% of the time you have to believe that gold makes its way to 1305 for that to be a profitable trade. So I would leave it to how bullish people are. I personally would not mind that exposure, just to take a shot there to the upside, because I think the resistance really doesn't come in on the medium term chart for $60. So I'd be looking to buy calls below that if I was interested in playing the direct event risk and perhaps hedging a portfolio. That's the other thing to consider. If you're long equities right now and we're seeing that stocks are going down, and that's typically a catalyst to the upside for gold, you might just want to buy gold or have those options. Hey, you lose the premium, no big deal. You are hedging your much larger position in the equity market. And I don't think that's a bad play at this point, given the distance I think gold can run until it runs into any significant resistance on the upside.
Sure, that makes sense. What about taking a look, at the way you're looking at options for different strategies? Like if you were to take a look at the S&P right here, like the mini S&P, which is, like you said, it's down 50 right here at 2638, structuring things, whether it be looking at the weeklies or, different things like that. Are there any sort of like put spreads or call spreads that make sense?
One of the things I would just say about equities, there's a major skew, and I don't have it up here, but generally in these markets, the price that the equidistant puts will trade at relative to the call from the at the money is significant. That just means right here, if the S&P is trading 2640, the 2540 calls are going to be puts will trade at a much higher premium than the 2740. The call is $100 higher. So the one thing I think you can look at with the equities is that as volatility expands, the potential for it to come in should you rally or should this all get bought is far greater, right? So you see what happens to the volatility on days where the S&P lately, has a 50 handle recovery or something like that. The volatility starts to come in. So in that case, if you were looking to collect a little premium, I don't have the numbers up in front of me, but one thing you can do is look at selling call spreads, maybe a month or two out, so that if this volatility dies down, even if you do go up and the volatility dies down, being short those call spreads is usually not bad, because the volatility that you're selling tends to come in really strong. So I personally find it very challenging on the downside to try to structure any trades with the puts, because the way I see it, and I guess it all depends on your view, and Michael, please share yours if you have one. But the way I see it, the challenge here, going back to 2017, there was what looked to be a pretty solid uptrend line to me, and at this point, that's broken. So in a situation where you see a trend line that you've believed in and looked at and have followed, that you have reason to believe might be a pretty good indicator of buying, once buyers get taken out at this level, this may just be a dip to try to fake everybody out, but it's also possible it's the real thing. And if it is, and you're at risk of a move down here to where the trend line began to the upside around 2,300. So I definitely wouldn't look to be selling puts just because they're getting more expensive, because while it may work, I think you're in a situation where, based on the medium-term chart on equities, you're at some risk for an accelerated move to the downside. And as we've seen, once volatility starts to pick up, ranges tend to expand, and the potential of a 5 standard deviation move becomes far greater when you get to 2 standard deviations than a 3 when you've only gotten to 1. Basically saying that once you start to move, the likelihood of more movement is greater. And there's some real damage done to this chart. It may come back. I'm not saying I'm bearish equities, but I wouldn't be looking at put strategies here, just because some people might say, well, the volatility's juice, good time to sell. From a risk reward perspective, I wouldn't advise that.
Well, you're definitely right. Without a doubt, there's a massive skew to the put side. Just looking out, even, take a look at Monday. Hang on. Monday puts.
Sure.
If you take a look, $40 on the put side. Right now we're trading about 2640 in spot. The 2600 puts are trading 15 bid right now, whereas the 80 calls are 9.5 bid. So
15 and 9.5.
Yep.
Yeah, and that's how massive it is. Now it's priced that way in part because as you go up, they know that the demand for the calls isn't going to be there because, if the S&Ps rally 40, 50 handles,
Ball will
all
drop.
yeah, everyone will, relax a little bit. So the demand for the options will sort of disappear. So that's why I think the gold play, is an interesting one. If you're just looking to hedge your portfolio, the things I like about the setup here, if you see my cursor over gold, is that you have a consolidation pattern around here, that, like you said, that 1190 to 1210 area. And when it moves out of an area, the buyers, just like we were talking about with the equities, maybe the buyers were cleared out at that, historical trend line. Maybe the sellers were cleared out here around 1220 in gold. And that's why you see this markup and this continuation to accelerate, because the sellers down at 1200 aren't looking to, add their shorts and scale in. They're going to say, let me wait until we get back to a point on the chart where there's been some good, reason to believe there's historical sellers. And I think that shows up here at 1300. So I'm not going to, advocate necessarily any way that you need to do it. But I would just say, if you're somebody who has a lot of equity exposure, look at the golds and the options in gold and where they're priced. It might be a good hedge to your portfolio when you take a deeper look at it.
Yeah. Sorry, I'm just getting some messages right now. So I think they've made an arrest on this bomber person, and coincidentally, I think this guy lives within like 10 minutes of where I am. More information to come. Hope I don't know this guy.
Yeah.
Go ahead. Yeah, it's pretty crazy
Have you
stuff.
seen Have you seen a
I
picture of it?
haven't. I haven't. I'm just seeing some. My wife is like texting me, and I just went online and I'm seeing different stuff from the same town where I live. So we'll hear a lot more over the coming hours about this.
Yeah, that's crazy when you're near something. I work near the Time Warner building, and I was just taking a walk outside, and I saw the.
I saw something else. What? There's some other story going on there. What's going on? Is there something out of New York as well?
No, this was the other day when they had the packages being sent around because CNN is in that Time Warner building.
Oh, maybe
So
that's why they were showing it.
yeah, so there's been a lot of stuff. I mean, look. I think the important thing, we were talking about it earlier, and you'd pointed out to me that, that news it didn't look like there was any major correlation between breaking news on that and the way the markets were reacting, is kind of just a sidebar. But at the same time, I do think that it's important to consider that it's more likely that events that are extreme, where people will go to extreme measures, in the political world, is greater going into an election cycle. I mean, November 6th. Today's what, October 26th. So we're less than 2 weeks away, and there's going to be a lot of posturing. There are a lot of people who are going to grab headlines, who may do extreme things, to try to win support for their party or their candidate. People take the gloves off and go at it. We've seen, American politics is not nice, and potentially that leads to more volatility in the next week or two. So, I really think the way I'm seeing it in my mind, Michael, is just, let's see what happens for the markets going out to that November 6th and the ensuing days after, and let's digest how the market reacts. I really don't want to have too much longer term risk out here, because there's shorter term, things that might change the way I view the longer term picture. And therefore,
Absolutely.
I'm just not looking to take on super long duration bets here. You know what I mean?
Oh, 100%. You're not alone there. I mean, this market's changing every 10 minutes, so it's better to have some shorter term plays out there. What?
Yeah. Go ahead.
No, I was gonna say. So on that note, with kind of like shorter term plays, like are there one or two kind of shorter term setups that you're looking at that you think have great risk reward opportunity?
No, I don't think, let's go back to the last time we spoke. We talked about, we're trading 1205. I did the math on it. We talked about the 1245, 65, 1x2. And it was flat premium. You could buy the one and sell the two. And, we talked about, is that a good bullish play? And I said, well, now that, by the way, that's in the money. The 1240 call is now in the money as we trade 1240. But I looked at the price of it, and here's the 1240 call at 1880. Here's the 1265 call worth about 970. So actually, right now, had you bought the one and sold the two, it would be a losing trade. It's more profitable at this point it's close, right? It's very close to zero. But at this point, owning the two is in favor, even though the 1240 went into the money. So I point that out to say the difficulty sometimes in structuring 1x2s in the gold market where you buy the one, because it gets very scary when you start to move a little more quickly. And since volatility has been priced so low, the potential for it to expand a great deal is higher. So I hate in these kind of environments, what I would caution against, sometimes I caution more against than actually recommending the given trade. I think more about what I don't want to do. What I don't want to do is buy one of these 1x2s in here in this environment, say the 1275, 1305, even though I kind of like that because of the resistance levels. But if I think that there's potential for more volatility in the market, I don't really want to be selling two options in any space. But a call spread, for instance, this is a spot I would love if you wanted, instead of just paying the premium on the outright, the 1305 call, right? We mentioned earlier that on the chart, this 1305 area see where my cursor is. You can see across here has been this major kind of flip zone where gold makes its way up, and then once it dies through 1305, it tends to collapse, much like it did, since last summer. So this is real good resistance, and I think this 1275 level is meaningless. I think once we get through here, these sellers are all gone, and they'll wait until we get back up to 1305. So I might look to structure a call spread, buying a 1275 call, which right now I don't see an offer. There it is, 750. So I can buy that for $7.50, and I could sell the $13.1305 call for $3.50. So I'm basically paying $4 for that look. Where if it settles at 1305, I've made $30, and I'm only paying $4 for that. So to go back to the way I price the options, if I'm only paying $4 for something that, if it works, I make $30, I say, how many times does 4 go into 30? 7.5. How many times does 7.5 go into 100? 12, or about 12, right? So about 14. So if I think that there's a chance gold goes to 1305 and sits at expiration, if that happens 14 to 15% of the time in the model that I run, then that's a fairly even bet. But if you think, as I kind of do, that number is more like 40%, that you're going to get that move into the election, and that you're going to recognize that kind of money, then I think a call spread like that is very cheap. So we'll talk more about this in future discussions, Michael, but this is one of the ways I think you can think about breaking it down and understanding your odds like casino is, if you're looking at situational risk, you say to yourself, okay, where are my targets and where are my resistance levels? What do I think the probability of those events are? And then how does structuring the options pertain to that, so I can figure out if I'm getting good bang for my buck on a trade? And that's why I think this 1275, 1305 makes a lot of sense, because there's room there on the chart for it to run. And I think 14, 15% likely of the time does that happen in infinite simulations. My bias is yes, it does. So I like that call spread. Next time we talk, we'll see where that took us.
Yeah, absolutely. We'll definitely keep track of that and talk about that sort of thing.
Yeah. So I was also, one thing I wanted to mention. I'd like to have a little more insight on it before I take sort of a bigger opinion. But one thing about copper specifically that's been going on, there's been a big uptick in the CME copper volumes. I was just taking a look and talking to some of my friends at CME, and the average daily volume on the options in copper last year, or like January to June 2017, was about 180 a day, and now there's about 1,600 a day. Now, copper tends to be a little bit wider, but if you look actually now, the screens are getting, much tighter and much more efficient. But generally, things will trade a little fatter in copper, because it's not quite as developed as gold, but at the same time, you have a lot of interest coming in, and still probably a little bit more potential for volatility. So I would definitely suggest for people who are trading a macro position, perhaps have exposure to or concerns about risk and exposure to the Chinese markets because of the impact and correlation with copper there. I would definitely suggest that people take a look at what's going on in the copper options market on CME, because I think there's potential for a continued growth in volume there.
Do you think that's something that they've just added market makers in a concerted effort, or is it something that volume is just picked up in the product? It's actually interesting as you bring up copper. I think copper's held in pretty well given the equity sell-off. You know, a lot of people call it Dr. Copper and how it's so correlated with the global markets, things like that. It
Yeah.
hasn't really dropped a whole lot with this equity volatility and, you know, emerging market volatility.
Yeah, well, I think one of the things that I was talking to Ed Meir, also from Commodities Research Group, who I know you speak with frequently, was pointing out to me that, despite just what you said, is that with all that's going on out there, as you see, this is copper on a 3-year look. It's actually, holding its own in here. It's not collapsing, and the support back here, what year is this? In early 2017, it's kind of come into this support pocket, and it looks like there's still some buying. Anyway, what Ed had mentioned to me was that, despite some of the concerns about tariffs and, the long-term global economy, that the stocks of copper are not increasing. So generally, the supply-demand balance looks like it's decent, and I think that's why it's an interesting market to look at right now. When you see something that you might expect to be going down, holding in, that could be evidence of a buyer in the market. I'm not suggesting it is, but sometimes that's how it works out. And in fact, that's exactly what happened last time we talked. Was we were saying that gold down here, we were impressed with that it was holding up around 1205, because there was all this talk about raising interest rates at a higher pace. That was the thing that was big in the news on October 5th. And despite that, gold managed to hold in and find buying, and obviously since has gone up. So sometimes it's good to pay attention to, not what you think is logical in the market, but when what you think is logical isn't happening, and maybe that's a sign of a shift in demand, or some early signs. And if you can capture that and be aware of it, you can put some trades on that can profit nicely if you catch it early enough.
Yeah, certainly. Absolutely. All right. Well, hey, that's Ben Ryan, Commodity Research Group. Any closing thoughts with all this volatility? Anything you're focusing on in the very short term? Any signals you're looking at, or just?
Yeah, I would just reiterate very quickly what I said, is that for people who are looking to put options trades on in the equity market, the fact that volatility goes from 9 to 15 or something like that doesn't mean volatility is a sale, because it'll revert to 9. Because once you get from 9 to 15, or as you start climbing, the chances of an accelerated continuation is greater. Just go back and look at any VIX chart, and you'll see that over time. So I think if you're worried about equity exposure, I think a little gold exposure here to the upside, perhaps the 1275 13 call spread we talked about, or 1305 call spread, is great. And if you're looking at the equity markets and trying to figure out an option trade, I just don't really like, based on where it is on the chart, I'd be careful about just selling naked puts here.
Yeah, well, absolutely. All right. Well, thanks a lot, Ben Ryan, Commodity Research Group. We really appreciate you taking the time, giving us some great information. We'll speak to you soon.
All right. Thanks, Michael. Take care.